Good morning, everyone. Welcome to our thematic Corporate Connect session today, featuring REITs, organised by SIAS with the support of SGX Group and REITAS. I'm Charmaine from SIAS, and I'll be your host this morning. Today's session is a little different, as we're delighted to have two companies joining us together for the first time in quite a while. We'll start with a presentation today by Sasseur REIT, followed by a short video. After that, we'll welcome Stoneweg Europe Stapled Trust, or SERT for short, for their presentation, followed by another video. After both presentations, we'll invite both speakers back on stage for a panel discussion, moderated by Ms. Nupur Joshi, CEO of REITAS. To begin, we're pleased to have with us Sasseur REIT. Please join me in welcoming Mr. Cheng Yuen, Chief Executive Officer of Sasseur REIT, to the stage to share more about the company.
Thank you, everybody, for taking a Saturday morning, which you could have spent with your children, your family, or having a good coffee at a nearby hawker center. On a Saturday morning, you come and give us a chance, and we are really appreciative, and we will try our best to share the best of what we know about the company and the potential for you as unit holders or investors in future. But first and foremost, I would like to thank the organizer. First and foremost would be SGX, and then SIAS, as well as REITAS, Nupur, who is the CEO of REITAS. So she mooted this idea of having, as an overseas REITs, one of the problems that we have is that we don't have a physical property in Singapore. So when Nupur called me a couple of months ago, telling me, says that, I want an online version of your physical mall. Straight away, I told her, yes, I want to show the online version of our outlet malls in China. And later on, Elena will be showing you what they have in Europe, okay? So that you all will be able to you will be able to appreciate what we are offering to you, okay? So thanks to all this, yourself and the organizer. So then the next thing is that maybe because it's an early morning, I just want to throw a little bit of quiz, which was actually inspired by one Mr. Leong. Just now when I was taking my tea, you were actually trying to pronounce the name of our company. So over there, okay. So I give just a simple quiz. The one who make it right, we will give you some token of gift, okay? So what, I'm going to give you two options. Then you choose which one is the correct pronunciation. Even for myself, when I first joined, I had a problem. I was just wondering how to pronounce this word, okay? So first and foremost, number one is Sasseur. Second word is Sasseur. Okay, put up your hands. Tell me which one is the correct pronunciation. Who is number one? The lady there is number one. Which one? You are right. Okay, please give a token of gift. So maybe just a simple background on how this word came about. Actually, it's a French word. It's a French word. What does it mean? It means that it is someone who actually go by the ocean in the early days, where they use a filtering machine to filter the ocean of sand to see whether they can filter out gold or gems. Another way is that, you know, in the olden days in France or in Europe, where you have flour. So flour has a lot of raw materials. You need to sieve through to get the fine grains. So how this name came about, why we adopted this Sasseur. So back in 1989, right, our founder, Mr. Joshi, after he has taught in a university for 6 years, he got tired and sick of it. So he said, I will start a coffee shop in Chongqing. So in Chongqing, right, this small little, you can refer to our annual report on the picture. So in this coffee shop, right, he spent renminbi $6,500 to set up this coffee shop. And he was, at that time, I'm not sure the older generations of Singaporean, do you know this singer called Su Rui or not? So Su Rui sang a song called Sa Zhi Chuan. So he decided to adopt this name. Then he has a French teacher who is his friend. Hey, you also need a name which represents Sa Zhi Chuan. So he recommended him this name, Sasseur. So which the Sa and the Sa actually sounds the same. And it also represents the dynamics and the culture of this firm, Why? Because we sieve through all the products, we give you the best, and we give you the gem. That is how this name came about. Okay, so then after which he started his office in his cafe in 1989. Then he branched on to represent. He was in Italy for 2 years. Then he got all the branded goods, the fashion, the ladies' fashion in Europe, and he start having shop unit. And then after that he expanded. Then back in 1998, he decided to buy this Chongqing Liangjiang, which later on I will show you a video. It used to be a factory. But at that time, he was thinking, should I do this? But he felt a conviction that outlet is the way to go in China rather than the traditional retail mall. So I will share more later on. So with this, what I will do is that I will quickly run through our results with you. I will just highlight the key points, and you have any further question later on in the panelists together with Elena and Nupur, you can raise it to us. Okay, so now please. Okay, this one is our, I will just quickly run you through this. So we were listed in 2018. Our total market cap now is 860 million, and our portfolio valuation at 8.4 million. So the total space that we have, for example, I highlight to you Hefei, right? The GFA is about 147,000. So how do I translate that to the size of this place? You all know VivoCity? Because Singaporeans, we all like to use square feet and not square meter. But in other places, we use square meter. So the size of this, right, is actually about 1.5 times the size of our VivoCity. The VivoCity is about 1.1 million square feet. So this is the size. So of course, we have Chongqing, Liangjiang, Bishan, and Kunming. Next page. So this one shows the group itself. So the group itself, just now I mentioned to you, they started in 1989. As of now, they have 18 outlets in 16 cities. So all the red color dot are all the outlets that they are managing.
What took you so long to get listed in Singapore?
We were listed in 2018. Okay, because when they started and we actually started in 1990, the outlet 1998. So that time, I think the S Street market, our S Street market only started in 2022. If I'm not wrong, the first listing is actually 2002. Ascenders or Capital Land? Capital Land. So it took a while, right? So it takes time, right? And then Singapore that time they focused on the local GLCs. So it took a while. Then after that, when time is right, he was deciding between Hong Kong and Singapore. But he decided on Singapore because of our compliance, our governance, and of course our reputation vis-a-vis Hong Kong. And Hong Kong, the REITs market actually is not as active or as huge as Singapore compared vis-a-vis. Okay, so this one, okay, you broke my momentum. Let me come back, okay? Okay, so this introduction. So now we have 18 outlets, and the model is called a super outlet. So this super outlet, what is the distinctive feature? Basically, it comprises art, culture, and retail. Why art? Because art itself, you look at the building, all the buildings actually have a similar kind of design. It's the castle type of Italian castle, which is brick in color. That's what they like. But now we have a problem with this. You know why? The brick, after fair went there, it start to fall off. So now we have to change a little bit for new outlet in terms of our design. But we will still maintain the so-called the brick feature and the tower feature. Okay, now this one I will just touch on. I won't bore you down with the full model. Our full model can be encompasses into this formula. A stands for art, 1 plus N, exponential experience. Now you know that there's a lot of competition in terms of retail. Even in Singapore, when the RTS opens, right, maybe our retail in the northern side may be affected because many of us will be traveling to JB 1 to 3 in terms of exchange rate. So in order to actually hold people, that means the dwell time. We look at the dwell time, meaning how much time they spend at the outlet. The longer they spend, the more the chances they will spend, correct? So what we do is that, for example, we focus on this N factor. If you ever had a chance to go to Shanghai, please take a bullet train to Hefei to visit our mall. Let us know, our IR know. We will arrange for somebody to bring you around. We actually have a zoo in the outlet mall. So this animal, I forgot the name of this animal. So this zoo is actually at the rooftop, indoor and outdoor. So they will pay a ticket, children and what, they will bring the family will bring the children, they go to the zoo, they can feel the zoo, feed all sorts of animals. I cannot remember the name of this thing. Can you remember the name of this? Okay? Oh, okay. So a lot of unique so-called animals inside. So, but this one is not our key income generator. Our key income generator are the international brands, our domestic brands, and our sports brand. But why do we have that, our model? Because this will bring in the crowd. This will bring in the footfall. Later on in our subsequent slide, you will see that actually our footfall for the first half 2026 is already bigger than the size of Singapore population. 9.8 million people of footfall. Okay, so next page. Next page. Okay, this one, this is our first half result. So in terms of DPU, we grew by 10.2%, giving you 3.366 cents. We will be paying out on the 10th of September, right? 10th of September. So you are still in time to get this 3.366 cents if you buy our shares now until the dividend date. Okay, so then we have a record first half sales of 2.34 billion. This is in renminbi. And then you know now that REITs are affected by the cost of borrowing. But actually for Sasseur REIT, we are actually not affected by the international interest rate, whether the Fed, the SORA, and all this. Why? Most of our debt are actually in RMB, and in 100% of our debt. And this debt level, the LPR, that means the interest rate in China, they have been pulling it down because they want to activate and trigger their economy. So we still managed to bring the cost of debt down from 3.7% by another 0.7% down to further lower to 3.7%, which is 0.7% lower than our last December 2025. So why this is important for potential unit holders like you? Because for every cent of interest rate we send, what is that translated to, madam? Translated into higher distribution income. Okay, so then we can pay you a higher DPU growth in future. Next slide. Okay, this one basically is our total attractive return. So over here, you will see the DPU that we have been paying since we were launched in 2018. So in 2016, don't mind you point for me. In 2016, we already paying you for the first half 3.366 cents, which is 10.2% higher than last year. And I'm quite confident that by end of this year, we should be giving you something higher than what we have given you last year at 6.138 cents. So a few dates for you to remember. Our ex-dividend date is on 10th September, record date 11, and payment date is on 24th. Okay, next page. Okay, this is our strong, robust financial performance. Next page. So this one, I won't bore you down with the technical details. So, but I will just highlight something for you. So you remember what happened 6 years ago in China back in 2020? 6 years ago, COVID, and they have a total lockdown. Back then, our 4 malls was closed down for 6 weeks. Nobody can get in. But in first Q, we still managed to pay our unit holders the base income. The reason is because maybe you point to the outlet sales because of our model. So our unit holders, regardless of whether the sales is 0, 1,000 or 1 million, they will be guaranteed a fixed component, warranted by our sponsor. First and foremost, the model is that we have the outlet sales. Don't mind you point it. We have this outlet sales portion that says $100, and then we have the gross revenue, which is about 10 to 16%. Then from there, we will derive the fixed component. This fixed component has a base started in 2018, and every year will increase by 3%. And the variable component is a percentage of total sales. This will allow our unit holders, if the sales go up, then you can enjoy the fruits of the so-called sales. But if the sales is zero, let's say another lockdown, right, for 7 weeks, right, you will still have the fixed component. In short, this is how our EMA agreement protects the interest of our unit holder. Next page. This page basically just quickly go through a few highlights. Basically, our sales up by 7.4%. Translated to converted to Sing dollar is 6.8% up, which is about 65 million in terms of Sing dollars. And as usual, the last row will be our DPU, up by 10.2%. Next page. Okay, this page shows a healthy balance sheet. So our net asset value since 31st, 2025, as compared to 30th June, has increased by 0.03 from 79 cents to 82 cents, which is up by 3.8%. The key reason is because of the appreciating renminbi. So that brings our investment property up from 1.53 billion to close to 1.6 billion. Then, of course, there are other liabilities in renminbi due to the strengthening renminbi. All this actually improve our NAV. Next page. So this one is our debt. Like I have mentioned, all our debt are actually in RMB. The first column, 223 million, which is about 49%, expiring in 2030. So these are offshore sponsor loan because our sponsor actually is quite cash rich. So, and then they think that the banks are not giving us a very good rate. So that's why they offer us this loan. Then on top of that, we have an onshore bank loan of 172 million and an onshore bank loan of 57 million by a local Singapore bank. So all this, all in all, is 100% loan. Why this is important? Because we are operating in China. All these are in renminbi. So we are hedged against natural hedge. So for example, if I have a SGD bond, so meaning that my income is in RMB. If let's say RMB depreciate, then I have to use more RMB to pay the SGD loan. But in this case, this is a natural hedge. And I can't say because we are binded, but what our cost of loan will continue to come down. Wait for our next update. Okay, next. This one basically is just our so-called, this shows our capital management. So in terms of gross borrowing is about 25.6%. I'm not sure, are we still the lowest or Centurion is the lowest? I'm not sure. Office REITs, I'm not very sure. So our headroom is about 865 mil and interest coverage ratio is 5.6 times. So our shareholders, you can sleep in peace at night. We have lots of cash flow to support these REITs. Next. Okay, this is our portfolio performance, which I will just quickly run through. So again, you will see that our total portfolio sales versus 2Q versus last year 2Q up by 2.1%. There is a slight drop for Kunming. The reason is that they did a major reclustering of brands and AEI work. So during a reclustering and AEI work, there will be a vacant period. So this actually affected the sales. But this is short term. Once the 3Q is materializes, we will see an uptick. So in terms of first half, 7.4%. So another one is that this is actually our record first half portfolio sales since we were listed in 2018. This first half of 2.34 billion in terms of sales since listing 2018 is our record sales, despite China having a so-called weaker consumer demand. I will share with you the reason why. Next. Okay, this is another highlight, close to 98%. Slight drop basically due to Hefei outlet, where there was an occupancy decline due to a temporary vacancy due to our tenant reclustering. And then there was a big cafe, about 834 square meter, which terminated their lease, but we found a replacement in July. The rest of the lease, Chongqing Liangjiang, continue to be 100% since 2018. Chongqing Bishan close to 99, and Kunming 99%. Next slide. So this is our weighted lease expiry. The figure that I want to highlight to you is 1.5 years. Don't be alarmed by this. Okay, why? Most of you, if you are invested in the Singapore REITs, you would like the WALE to be as long as possible. Why is it so? Because when the WALE is long, it means that your leases are very long and you are guaranteed an income, say 3 years or 5 years. But first and foremost, I need to highlight to you, Sasseur actually operate differently. Why we operate differently? More than 95% of our leases, the tenancy agreement is based on commission. Meaning, if the tenant make $100, we will receive $15 in terms of rental. But if they make $0, then our rental will also be affected. And since 2018, but the sponsor actually started this business back in the 90s. It works. Why? The consumer taste in China change very, very fast. I think you all can read it, read from the internet. So if I have a tenant which actually takes 3 years or 5 years, if they do not perform, what happens? I cannot replace them. I cannot kick them out. But we want it purposely short. And then and do you know how we operate at the ground level? It is not like a typical mall, right? Okay, you pay me $10 in terms of rent. I don't care how you operate. You will just run it. I just make sure every month you pay me $10 in terms of rental. But for us, it's different. The general manager on the ground would actually, because our rental is tied to their sales, would actually set a target for all these tenants. I want you to hit a minimum sales, says $1,000 this week, $2,000 next week. And every week, they will actually have a meeting with all the tenants and tell them whether have you hit target. Because all the sales are captured in the POS system, point of sale system, or into our bank. So straight away, on a daily basis, they will be able to see what are the sales target. The minute they cannot hit the target, they will be hauled up to meet the general manager. Hey, what are you doing? What can we do for you? So that's why you see that despite the weakening consumer sentiment, we still achieve record highs since 2018. This is the difference, and why we need the WALE to be short, so we can change them anytime they are not performing. Next slide. Okay, this one is just a part of AEI which I was mentioning to you. So on the first phase, we have already completed, where actually in Hefei, I told you, bigger than Vivo City, right? We converted one block, right, into sports zone, 6,000 square meter. Why we want to do that? Because the demand for sports and outdoor apparels is actually on the rise in China. Because the Chinese government also promote healthy lifestyle, so they can cut down on their medical costs. So all this sportswear and all this actually also in a way affected by this, and people find that sportswear you can wear in all sorts of occasions. I think many of you here are also in sportswear as well. So that's why we converted one into this. Then the other one is in Hefei, we repurposed the cinema space. In Hefei, we used to pride ourselves as one of the biggest cinema in Anhui province. But now this is not something that we want to be proud of. You know why? The reason is this: do you still go to patronize the cinema so often, or you watch your video on your handphone or on your tab or computer? So what we did is that we took back about 2,000 space from this cinema operator, which so their business is not doing well, and we converted into F&B. So when we actually curated, I won't name it in Chinese, this Hu Tao Tao Bada. This is the first, is a seafood restaurant, first time operating in an outlet in China. So it's a branded one. So this one, the next phase, this is also for Hefei. This is for Hefei, called reclustering. We push the international brands to another block and the sports brand back to the international. This is just, I won't bore you down in the details, but this is part of our job on the ground to put the brands according to the area they are, so that they will be exposed maximum, foot traffic will be there, and so that our sales can go up. Next. Okay, this is basically collaboration with brands. Maybe I have a story to share here with you, how we run at the malls. This is in Kunming. I think everybody knows about KFC, right? Kentucky Fried Chicken. So Kunming, right, actually has a date corner. This date corner was previously selling Samsonite brand. But then their business isn't doing very well. The reason is because there is first is a date corner. You know, shopping malls surely have date corner. Then the service counter is there, and then their brands are being blocked by the customer service counter. So they say, oh, I'm giving up this. Samsonite say, I'm giving up. I don't want to do it anymore because my sales is no good. So then the operational team on the ground, 6 months in advance, already knew this. So what they do is they start talking to KFC. KFC is very popular in China. But then they also know that KFC don't like this space because of the customer service. They block their signage. So what they do is that the ground team already on the ground. Okay, I will hide it under my sleeve. I already work on moving the customer service counter to another area. So on the spot itself, when they were talking to KFC, I want this rent, I want to be 2 years, 3 years, or 5 years, and then the KFC say, but I don't like your service counter. Okay, we will move straight away, immediately. So KFC have no choice. Okay, I agree to your tenancy. So now KFC is in our Kunming outlet. So this is, I want to share the more on the ground one so you understand what are our operational strength. Next one, looking forward. Okay, first and foremost, I think most of you are aware, we track the consumer confidence index. So as of June, you will see that actually it has slid to 89.4, but our sales are not affected because we are a differentiated outlet format. Okay, so that's why I'll share with you how we run, how we promote, and how we do the tenancy agreement. All this, all in all, actually helps us to go against the tide. Then the next one, of course, there's certain policy, like for example, their first 5-year plan, they are going to expand the consumption because now you know of this trade war, of this volatile politics, global geopolitical reason. China, in order to continue its momentum of GDP growth, they will need to trigger and liven up their domestic consumption. So this will be helpful for us. Next slide. Okay, this one, I will not go through this. Later on, with this, I will end my presentation. And with this, I will bring you to Chongqing, Liangjiang. Enjoy.
重庆是中国最大的经济中心之一，也是全国9大中心城市之一，在推动中国西部经济发展中拥有举足轻重的战略地位。凭借3100多万的人口规模和持续增长的居民消费能力，重庆已成为沙之船房地产投资信托投资组合中最具韧性的零售消费市场之一。沙之船房地产投资信托旗下4大奥特莱斯项目之一的重庆两江奥莱，就处在这个充满活力的市场之中。沙之船房地产投资信托不仅是亚洲首个上市的奥特莱斯房地产投资信托，也是在新加坡证券交易所上市的唯一一个专注于中国奥特莱斯资产的房地产投资信托。该项目位于重庆两江新区核心区域，战略区位优势显著，充分把握了中国重要消费市场持续发展的机遇。项目始终保持100%出租率，并于2025财年实现奥莱销售额同比增长5.1%。这一成绩得益于精心打造的国际精品与生活方式品牌组合。
沙之船重庆两江奥莱是超级奥莱的起点，也是重庆生活的坐标。作为沙之船集团首家奥特莱斯，也是重庆首家专业奥莱。我们以艺术商业、超级奥莱为核心理念，将购物、休闲、文化体验融合成一种耳目一新的生活方式。我们不仅重新定义了重庆的商业格局，更以持续的创新力，成为领先亚洲、推动世界奥莱行业发展的超级奥莱品牌。
我们打造了2万平米的国际名品街，并融合了以+39意大利空间、奢侈品集合买手精品百货为主力店等60余家全球知名品牌。在这里，让您不出重庆就可以用更亲民的价格，体验到与国际同步的时尚潮流。这正是沙之船名品加折扣核心模式的魅力所在。
这里是城市社交新主场，运动与潮流是当下年轻人的生活方式。我们引入了众多国际一线运动品牌和当红国内外时尚潮牌，打造了充满活力的购物空间。这里不仅是购物的场所，更是年轻人交流、分享、展现自我的潮流聚集地。同时，我们也一直秉承着真正奥莱价、买贵赔差价的价格承诺，让您在此真正实现运动轻修潮牌自由。我们拥有100家女装品牌，为女性消费者提供覆盖不同年龄段的全场景穿搭空间，涵盖中端、中高端至高端的女装市场，精准满足日益细分的多元化需求。在这里，不仅仅只是买的购物圣地，也为您打造了一个可以慢下来、向内探索、与美好日常温柔相处的奥莱生活方式。
从商务精英的品质之选，到萌娃潮童的时尚穿搭，再到精致皮具的匠心之作，让每一位家庭成员都能在这里找到属于自己的惊喜。在男装不止于衣，更是绅士生活方式的探索；在童装不止于穿，更是陪伴成长的用心之选；在皮具不止于物，更是匠心与品质的坚守。全家所需，一站尽享。
这里是城市度假的理想目的地，从二郎港的地道重庆美食，到星巴克的闲适时光，从霸王茶姬的东方茶香，到金穗河的港式风情，更有 KFC、DQ、李若桃、野人先生、瑞幸、面包路与影面等多元业态交织其间，让每一位顾客都能在此悠然度过一整天美好时光。
匠心打造零售体验之外，项目还创建了专属 VIP 会员体系，为会员提供从购物到售后，从日常消费到节庆礼遇的一站式定制化尊享服务。每一个服务细节都经过精心设计，以个性化、全流程的消费体验，让每一位会员都感受到真正的尊贵礼遇。沙之船重庆两江奥莱堪称中国奥特莱斯商业发展的传奇。作为中国奥莱200亿俱乐部常驻成员，我们以硬核实力领跑行业，以持续增长树立商业标杆。
奥莱的服装品牌很丰富，都是正品，折扣力度也很实在。无论是老人、小孩的衣服，还是我们自己穿的衣服，都是从奥莱购买的，品质方面我们很放心。
商场对我们商家很扶持，客流稳定。我们相信跟着两江奥莱会越做越好。
入驻两江奥莱10多年了，商场的运营能力和客流质量都超出了预期，管理团队专业负责，活动策划也很耿毅。我们对这里的长期发展充满了信心。
时至今日，沙之船房托持续加强市场对其差异化投资价值主张的理解，进一步彰显其独特竞争优势。随着中国消费的持续复苏，重庆两江奥莱已具备良好的增长基础，有望持续带动收入增长，并为单位持有人创造长期稳健的价值。释放价值，驱动增长。沙之船房地产投资信托。
Okay, I'm sure everybody has found Yuen's presentation to be very useful and insightful. Maybe just give him a round of applause again. Thank you. Okay, up next we have Elena from Chief Capital Markets and Investor Relations Officer of SERT, who will be taking us through her presentation and video today. Please give her a warm welcome.
Thank you, everyone. Welcome, and really appreciate you making Saturday a priority to come and listen about our small cap overseas REITs, China, and now I'm going to take you to Europe. So you see the origin country of what Yuen was talking about in terms of brands. I will try to make my presentation as lively as Sassur's presentation. I have very big shoes to fill. I'm also representing a sector that in many ways is not as exciting as retail on the brand side, but is very exciting on the numbers side, as you will probably see. And again, thank you so much to SGX, to REITAS, to Nupur. I'm looking forward for the panel later on, and to you investors for making it today. I'll try to make this about a 10 minutes presentation. A lot of the slides that I'll show have already been presented as part of our first half results, because I also have some very exciting videos to share with you. So moving on to the first slide. SERT's portfolio is 2.2 billion and is primarily focused on freehold, and I underline the word freehold, logistics and light industrial assets across Western Europe. The portfolio is highly diversified. We have nearly 800 tenants, and our WALE, unlike Chinese retail outlet retail mall, is actually quite long, 5 years. It's a different asset class, so it's just a different priority for us. The Netherlands, which is one of the top European economies, represents our largest market at around 30% of the portfolio, and anchors a footprint that spans logistics, including Amsterdam, as well as other destinations such as Paris, Milan, Frankfurt, and Copenhagen, which are our other core countries. Together with our growing data center development platform, which I will talk about in more detail later on, this provides a strong combination of stable income today with an opportunity to grow in the future. Moving on to the next slide. A lot of words here. I will distill it in a very succinct manner. Over the last 3 years, SERT, as many other of the REITs in Singapore, has gone through a number of difficult market conditions in terms of rising interest rates. In our case, we also had a change in sponsor of 2024, higher interest rate environments, as I mentioned, conflicts in Middle East, and all this has impacted performance across the board. We have, and I can stand this here proudly today to tell you, we have really transformed the operations over the last 3 years, and today we are in a much better position to take us to the next stage. We have strengthened the balance sheet, and I'll talk about it a little bit later on. We have also stabilized distributions, also something that I will touch on a little bit later on, and we see several great opportunities to create further values. Importantly, now we have a new, very aligned with you, unit holders and security holders, European-based shareholder and a sponsor owning 28% of the assets of the REIT units, which is now very much aligned with the interests of the unit holders. And maybe some of you have noticed the announcement that we made immediately after and together with our first half results, that we have launched a strategic initiative review of the fees. The objectives that we are aiming to achieve is increased distribution margins, improve performance, improve margins, as well as ensure even greater alignment with our security holders, and amongst the initiatives we consider an internalization. Nothing has been yet confirmed. Everything is subject to regulatory approvals and considerations, and I will not be able to speak on this subject in greater detail until decisions and further information have been released, but watch this space, as I told Nupur this morning. Moving on to the next slide, very quickly. We have repositioned portfolio for what was predominantly a 60% office when we launched this REIT, of some of you, if you remember, 9 years ago, to what is now a very focused light industrial logistics portfolio. We are aiming to achieve, as you can see, up to 70% by 2028 as a target. We have a growing data center and data center development component, which we expect to reach about between 15 and 25%. That very much depends on the appreciation of the underlying asset value. And we do have a small component of office, which we continue to maintain, which is expected to be between 15 and 25%. So you will increasingly see SERT as a logistics and light industrial and data center play compared to peers both in Singapore and in Europe. Moving on to the next slide. This is a slide I'm especially proud of, and I have to give credit to the previous finance people and also to the finance team and the treasury team. We refinanced over the last 4 years, I would say, more than $1 billion of debt, and we refinanced it in an increasingly rising interest rate environment. Gone are the days you're going to see in Europe 0 interest rate or anywhere else in the world, with the exception of potentially Switzerland. We are now in a higher for longer interest rate environment. You have seen the Fed making some announcements in terms of potentially increasing rates. Europe has kept the rates steady, but we have been able in this environment to achieve a debt profile which is actually something quite unique. As you can see, we have no debt expiries for the next 5 years, which gives you security holders peace of mind in terms of interest costs. As you know, interest costs are a key influencer on distribution growth, and with that removed out of the equation, with more than 90% hedged, you have very good visibility of our interest costs, and you know that the costs there will remain relatively stable. And that leads me to the next slide, talking about our distribution performance. This has been a very painful slide to put together and present to you, because you can see here the declining distribution. We own up to it, we take responsibility, we give context to the fact that we had to manage very, very difficult 3 years in terms of rising interest rate, and also make sure that our net gearing remains within appropriate guidelines. We now can say that we have stabilized that distribution, and we were the first REIT in Singapore to provide forward-looking guidance with our full year 2025 results, where we said that distribution in 2026 is expected to be largely in line with 2025. And I have seen now a lot of REITs have followed our example, so I think it's good for the industry that REITs are increasingly giving forward-looking guidance. It's an industry that's highly predictable. We have basically NPI growth and interest rate costs to manage. Yeah. Moving on to the next slide, just very quickly. This is a waterfall chart that is actually very helpful to illustrate which are the main drivers of our distribution. As you can see, a lot of it is income from investment in data center development and also our sponsored data center pipeline, some new acquisitions, income growth coming from NPI from logistics. Later on, I'll show you that our logistics NPI growth is just continuing to be very, very good, because majority of leases in Europe are actually CPI linked, and we have been able to demonstrate on average 5% rent reversion over the last 5 years, which is really quite something. People think about Europe is low growth, whatever, but fact is there, this is a very resilient sector. And of course, the highest impact on distribution has been divestments. I would like to highlight that these divestments have been made largely to make sure that our gearing remains within steady state, because we do have a lot of loans that are tied to gearing and tied to other performance. We have 2 investment grade ratings which we need to manage. And last but not least, we have a little bit of other income that has shown performance. So all in all, you see how from the first half of 2025, the growth to the first half of 2026 is 1.4%. Not as much as what Sasseur showed, but it's actually a very commendable growth, which we are actually able to say we are looking forward to at least achieve in line with 2025. Quickly turning to capital recycling on the next slide. What does this mean? And I just want to make a sidebar here. Our portfolio is close to 100 assets, and they are relatively bite-sized assets because Europe is a very old continent. The asset class there is 20-30 million that we have in terms of logistics and light industry and to a great extent office. It's actually a very liquid portfolio, which is actually a good thing because in times where we need to make sure that we maintain our gearing, we have been able to divest. What we have done with the money is actually invest in growth opportunities. So the last 4 years, as I have shared earlier, we have kept our head low. We've done our job in terms of managing the portfolio. We've raised no new equity. We have totally not cut distribution. We've paid 100% of distribution all along. And the beginning of this year, given that we have good visibility on our DPU performance, we were able to take the view that we can deploy some of these divestment into some potential growth opportunities. As you can see, this is core logistics assets in the Netherlands that we have purchased, and further 50 million investment in our data center, off-sponsors data center platform through a mentor convertible loan that actually pays a coupon of 7.25% and is actually helping offset the distribution. Yeah. Moving on to the next slide, very quickly, I would like to touch on valuations. SERT, for the last 4 years, even through highly rising interest rate environments and other turmoil, have only lost 3% valuation. I want to repeat that number. Only 3% valuation decline over the last 4 years, but the last 5 consecutive quarters we were able to demonstrate valuation growth. To a great extent, this is due to a very, very active leasing team, market rates re-rents, as well as asset enhancement initiatives. So these are some of the slides that just illustrate this. Moving on to the next slide, to our tenants. This is a very important component to consider, especially when it comes to our credit ratings. So I can share with you that credit rating agencies do not like high concentration of tenants, which means you have 70 or say 30, 40, 50% exposure to one tenant. And we have been able to highly de-risk our top 10 tenant base. When we listed this portfolio, our top 10 tenant represented close to 50% of our exposure. Now we have brought this down, as you can see, to about 22%. And we don't have any major exposure to any specific asset class, which gives you a lot of flexibility to manage in terms of tenant mix. Very quickly moving to our portfolio, at close to 94%, you can consider this a very, very high occupancy level for light industrial portfolio basis. It's practically full, especially when it comes to the logistics sector. Most of our countries are performing well. We have a couple of outliers in weaker office performances in Finland and Poland, but we are gradually exiting these markets. Moving on to the next slide, light industry and logistics. I really like this slide. And again, this goes to the point. People think about Europe as low growth. Well, this slide shows a different picture. Light industrial logistics is a reflection of the economic growth. And on that basis, you can see that specifically for our portfolio, and we have broken down light industrial logistics, we have consistently demonstrated positive rent reversion and occupancy. We listed this portfolio with 88% occupancy. Now we are at 94% and 95% for logistics. So you can see that we have really worked very hard, the portfolio, to achieve this growth. We maintain the same WALE as IPO, and on average, we lease 10 to 15% of the portfolio on an annual basis. Very, very resilient asset class. Very low capex compared to office, and I would like to underline this. Very quickly on the underlying Europe environment. And the European environment, as you can see here, we have also consistently seen across our key European market logistics rent growth. Of course, looking at the 2021-2022 years, it's very, very high because of demand during COVID. But even now, we are looking at quite a commendable rent growth quarter on quarter and half year on half year, which is really supporting our investment thesis in this asset class. Moving on to the next slide, I would like to quickly touch on office. And again, I am mindful that obviously we are in Singapore, and Singapore office has performed really well compared to US office and any other country you can think of. But I would like to highlight that despite the perception, European office, if you segregate it to core office and non-core office, is performed exceptionally well. Look at this portfolio. Our core portfolio is demonstrating rent growth, is demonstrating occupancy growth, and we have specifically broken it down so that investors can see the difference between these assets. If I can go to the next slide, I would like for you to see the performance between core and non-core office in Europe. Vacancy in core office in Europe is only 5%. This is similar to the vacancy that you have in Singapore and much, much lower than you have in US and other countries. It is essentially a very resilient asset class when it comes to core office, especially because in Europe people are very ESG conscious and they care about performance, they care about building certification. At the same time, office portfolios in Europe tend to be older, and only 20% of the asset class, office asset class in Europe is certified versus 80% of our portfolio. So all this is driving our continued interest to maintain a small core Dutch and Milan portfolio in this asset class, which has been very, very resilient. Just want to quickly touch up on our data center strategy. And I would like to say that this is a different type of approach from the stabilized asset data center REITs that we have listed in Singapore. Our sponsor has just announced a major strategic initiatives. They have completed majority investment in one of the largest crypto miners in the world called GDA. So our sponsor now has a very strong data center digital platform that spans between Europe and US. The core portfolio of this digital platform is AeonX, sponsors data center development fund that has 5 assets representing 2.2 billion in terms of underlying asset. And this is a very early stage data center. So we are not talking about stabilized asset that has been de-risked and are now going to yield 4-5%. You as an investor in SERT are part of growth that can potentially be multiple growth because the investment that we have made is an early stage data center development investment on an equity level in our sponsor's platform. So there's no capex required from us. We are just an LP investor, and at some point, depending on when that exit will yield some cash distribution that will then be given back to shareholders at some point in time. I don't want you to now ask me whether this is going to happen tomorrow. We need to wait for this to get some more further NAV growth. The development center plots and assets are in core European locations. And Europe is a very attractive data center market because of access to power permits. It's very highly regulated, so early entrants and highly connected vehicles like our sponsor have advantage in this type of markets. Just very quickly moving to the next slide, because I would like to highlight to you the difference between the investment that we have made in AeonX. The first 50 million investment that we made June last year was purely equity. We own about 7% of that fund as an LP investor, and that essentially is already valued 40% higher than our initial investment. So the 50 million is now worth 70.6 million. We are holding it on NAV basis in our business trust. The second investment was made in March this year. It is through a different type of product, mandatory convertible loan, which pays a coupon of 7.25%, which offsets the fact that we've used cash to invest in this. We used the revolving credit facility to invest in this product. But This is also a lower in terms of return because it's capped at a certain number, because it's capped at conversion to about 2x. So from a return perspective, you as security holder have exposure to AONX, which in terms of investment size is 100 million, in terms of return can be multiples, and this slide just goes through some of the numbers that demonstrate this. I just want to highlight, this is a main difference between us and a lot of the other data center REITs in Singapore, that we are providing that kind of growth opportunity as part of our portfolio. And just very quickly, I would like to show in terms of multiples and in terms of yields, we still continue to trade on almost 2 times the distribution yield as compared to European peers. Why this is important? Because we do actually have institutional European investors that invest in Singapore through our REIT, and this is actually helping you as retail investors because, as you know, institutional investors are price setters. As my last slide, before I move on to the conclusion, talk about ESG. This is a topic that has fallen off the radar for the last couple of years as wars and interest rate environment took precedence. But in Europe, this continues to be a very, very important topic. And I would like to highlight that this is actually a key capital depreciation, a key capital differentiator for us, because our sustainability credentials give us access to green financing, which tends to be priced a little bit better and opens different type of capital pools. So our entire debt book is now in one way or another sustainability linked. Our 800 million European bonds are green, and our 2 or 3 secured and unsecured facilities all have sustainability KPIs. Also, we are very, very focused on governance. Again, with like Sasseur, we are overseas REIT. We need to try harder because you don't know us. You can't always visit our assets, and we want to demonstrate that we care about governance. We have been in the past 7 years in the top 10 of our local index, as you're familiar with, SGTI. We are the only non-government linked in terms of sponsor REIT that has maintained that position for the last 7 years. Because we want to show that we really, really focus on governance quite a lot. And something that's quite important for our institutional investors, we have recently been upgraded to AA MSCI. This is actually a rating that is very highly considered by debt capital markets in terms of their decisions to invest on listed products. And moving to my last slide for conclusion before I take you on a whirlwind trip around Europe. In a nutshell, we are very, very sponsor aligned, or rather the sponsor is very, very aligned with you as the security holders, and we are positioned for growth. We have de-risked our balance sheet. We are continuing with our asset enhancement initiatives. We have a clear path to growth, both through logistics and through data centers. Macro is relatively supportive because Europe continues to be a very, very large economy with a lot of very, very sovereign, good credit countries that support our growth. In terms of strategy and efficiency, we are taking further steps for which we will announce further details as the time comes. And last but not least, we are also in a position to reinstate our guidance, distribution, forward-looking guidance, that we expect distributions for 2026 to remain largely in line with 2025. And with that, I will ask my colleague to play our European videos. You will see a very different set of videos. This was initially supposed to be a wheels on the bus, or I forgot what was the term, REITs on the move, right? What was, yeah, okay. Well, too bad, we can't take you to Europe, and now it's summer holidays, so yeah, it's very hot and you probably don't want to be there. But you will see how colorful, how exciting the destination is. I'm not selling it as a tourist destination, even though, yeah, but you will see where our assets are and appreciate that this is something that you can potentially consider as part of your portfolio. Thank you very much.
Welkom in Nederland. This relatively small country of just over 41,000 square kilometers is home to more than 18 million people and 24 million bikes. It is the country where the world's first official stock exchange was established in 1602, and 80% of the world's flower bulbs come from this small piece of land. Thanks to its strategic location, the country is one of Europe's most important transport and logistics hubs. Amsterdam's Schiphol Airport ranks among Europe's leading airports, while the Port of Rotterdam is the largest port on the continent, connecting global trade routes with Europe. At the heart of the national rail network lies Utrecht Centraal, with direct connections across the Netherlands and beyond. Amsterdam, Rotterdam, The Hague, and Utrecht together form the Randstad, the economic, political, and cultural core of the country, and home to nearly half of the Dutch population. The SERT portfolio in the Netherlands includes 15 assets valued at more than 652 million euros, primarily located in the Randstad, with a balanced mix of office and light industrial and logistics assets. Key projects include De Ruyterkade 5, a transformative redevelopment aimed at delivering best-in-class office space with world-leading ESG performance. Hague Support, a powerful opportunity to refresh an iconic building and renew a strategic tenant partnership with an anchor tenant.
One more time.
Smart locations, solid assets, and a Dutch portfolio worth talking about. Bienvenue en France. Europe's largest country by land, famous for its world-class wine, champagne, cheese, and the iconic baguette. The home of the Eiffel Tower and the birthplace of the hot air balloon. With over 90 million visitors each year, France proudly holds the title of the most visited country in the world. Perfectly positioned at the crossroads of Western Europe, France is a powerful gateway for trade, travel, and logistics. Bordering economies like Germany, Italy, and Spain, and with access to both the Atlantic Ocean and the Mediterranean Sea, it seamlessly connects Northern and Southern Europe. From Paris Charles de Gaulle Airport, one of Europe's busiest hubs, to major seaports like Le Havre, Marseille-Fos, and Dunkirk, France is built to move. Add a world-class TGV rail network and extensive motorways, and you have one of Europe's leading transport and distribution hubs. The SERT portfolio in France includes 19 assets, valued at more than 469 million euros, primarily located in the dynamic Paris region, combining 2 office assets with 17 light industrial and logistics properties, generating a strong 32 million euros in rental income. Parc des Docks stands out as a cluster of 8 light industrial buildings, valued at 172.1 million euros, with redevelopment potential within a broader gentrification-led urban renewal strategy. Parisine, in Paris's vibrant Seine-Rive-Gauche district, are developed possibility into purpose-built student accommodation, creating high-quality living spaces designed for student life, with shared amenities and excellent connectivity to universities and transport. A portfolio rooted in the Paris region, bringing together 17 industrial and 2 office assets, right at the center of France's economic engine. Benvenuti in Italia, Home to over 55 UNESCO World Heritage Sites, more than anywhere else in the world. From the timeless grandeur of the Roman Colosseum to the iconic Leaning Tower of Pisa, Italy is a living museum where history and beauty meet at every turn. It's also the birthplace of modern banking, led by the powerful Medici family of Florence, shaping finance as we know it today. Strategically positioned at the heart of the Mediterranean, Italy serves as a natural gateway between Southern Europe, North Africa, and the Middle East. Its location places it right along key maritime routes, connecting major European markets to global trade flows. This strategic role is reinforced by a strong transport network. Major ports such as Genoa, Trieste, and Naples seamlessly connect sea freight to continental rail systems. In the air, Rome Fiumicino and Milan Malpensa stand out as leading international hubs, while northern Italy's dense rail and road corridors link efficiently to France, Switzerland, Austria, and beyond. The SERT portfolio in Italy includes 14 assets, valued at more than 360 million euros. A portfolio with a balanced mix of asset classes, generating a total rental income of 29.7 million euros. Looking ahead, the opportunity continues to emerge. From its industrial roots to future potential, Via dell'Industria 18 represents a strategic redevelopment opportunity. Italy, where history inspires and potential drives the future. Willkommen in Deutschland, or as we say in English, Germany, a country that produces around 6 million cars every year, making it one of the world's automotive powerhouses. Yet one of Volkswagen's best-selling products is a humble currywurst. Germany has Europe's largest economy and plays a central role not only within the European Union, but on the global stage. Located at the very heart of the continent, it acts as a vital bridge between East and West Europe. Its extensive network of roads, railways, and airports keep Europe moving, seamlessly connecting goods, people, and ideas across borders. Munich Airport, ranked the second most punctual major airport in the world after Tokyo, perfectly reflects Germany's reputation for precision, reliability, and discipline. The SERT portfolio in Germany includes 14 light industrial assets valued at more than 220 million euros, generating a strong 15.1 million euros in rental income. With occupancy above 95% and long-term lease agreements in place, the portfolio demonstrates both stability and performance. Looking ahead, our focus will be on carefully managing upcoming lease transitions while safeguarding and enhancing value, particularly at Siemensstrasse in Frickenhausen. The SERT portfolio in Germany, delivering stable performance today while strategically enhancing value for the long term. Welcome to Denmark, the country that has 444 islands, of which only 76 of them are inhabited, is known for creativity, culture, and sustainability. It is the birthplace of Lego and home to Copenhagen's famous Little Mermaid statue. More than 50% of Copenhageners cycle to and from work every day. Its modern ports, bridges, and rail networks make it a vital hub for trade and transportation. Located between the North Sea and the Baltic Sea, Denmark connects Scandinavia with mainland Europe. From the Øresund Bridge to its busy shipping lanes, Denmark keeps goods and people moving across borders. Beneath the sea, transatlantic communications cables also pass through, carrying vast streams of data between Europe and North America, linking continents in both movement and information. The SERT portfolio in Denmark includes 12 light industrial assets with a value of just under 150 million euros, generating a strong 10.5 million euros in rental income. Stamholmen, a property consisting of 4 buildings about 10 kilometers southwest of Copenhagen. Sogneve, a complex of 5 buildings comprising predominantly warehouse and some office space. The property is located in the business park Prior Parken, a well-functioning and popular business park in Brøndby, located approx. 8 km west of Copenhagen City. A portfolio at the heart of Scandinavia's logistics powerhouse. Rooted in Denmark's culture of innovation, efficiency, and sustainability, it's a market built for the future.
Thank you, Elena, for the presentation and the very, very interesting video. Okay, now we will move on to the panel discussion. May we invite Elena, Hsing, Yuen, and Nupur back on stage to have a seat, please.
Okay, that was wonderful, wasn't it? Like, first the China videos, and then a tour of Western Europe and Denmark. So now we have to refocus on, on the important part of the business of the REITs. Okay, so thank you both for your presentations. I think I want to start with just zooming out a little bit. And by the way, we'll be taking audience questions, so I hope that, please keep your questions in mind. I'll pause a bit. Please don't go whoever is going. Okay, so my first question is as follows, and it's, I will get both Hsing Yuen and Elena to address them as they see. So Singapore investors and all of you here, you're all very familiar with properties, REITs with properties in Singapore. And I think part of the effort today has been to familiarize everyone here with the REITs which have properties outside of Singapore. So the question really is, what does investing in REITs with overseas properties bring to the table, and how can that broaden or diversify an investor's portfolio? Elena, would you like to go first? How does investing in a REIT with overseas property help to diversify an investor's portfolio?
Thanks, Nupur. I have the pleasure to be having been the part of Singapore's REIT industry, what is now 15 years, and I've worked in Singapore even before that, so I've been around. I've worked for both very large listed companies, and my last 2 jobs have been with REITs. Before SERT, I was working for a couple of years for another Singapore REIT that was just Singapore focused. So I can appreciate the difference between the two. I'm not saying one is better than the other. In my view, each has a part an investor portfolio, given that the REIT managers are doing a good job. From an overseas asset perspective, the Singapore market is richer for having REITs that represent portfolios that are not necessarily only Singapore-based. Singapore is a small country, it's a wonderful country, but it's only a finite piece of land. We have the distinction in Europe to have give investors the exposure to freehold properties. We all appreciate the power of freehold and the difference between freehold and leasehold. And of course, when it comes to homes, this is one story, but when it comes to commercial property, this is a completely other story altogether. Logistics and light industrial in Singapore predominantly leasehold, sometimes with very short leases. In Europe, our assets are 93% freehold, which gives us opportunity to do asset enhancement, to do redevelopment, to do change of use, and create much more higher value. And if you want exposure to different economy, to different currency, overseas REITs, in my opinion, give opportunity to investors to diversify their portfolios in that manner. We're not here with Yang to tell you guys how to run your investment portfolios, but we are just here to present alternatives to what you can potentially invest. And last but not least, 8 to 9% yield is quite good in my view.
Yes, Yuen.
Do I need to press on this? Hello, can you hear me? Okay, so I'm not sure whether most of you remember, decades ago, right, our second Prime Minister, Goh Chok Tong, he said that you cannot just fix your economic development in Singapore. We have to look at how many hours away from Singapore by flight. Can anyone remember? 7 hours, and within 7 hours of flight radius. So it's the same. If you are investing in REITs especially, you would see that most of the Singapore REITs, the yield is between 5 to 6%. Basically because most people still have a lot of confidence in Singapore properties. That's why the price and the valuation is higher. So, but that also resulted in a lower risk of 5 to 6%. Stoneweg, 8.4%, correct? Sasseur. Yes, 9% plus. But of course, that's not good news for us. We actually want it to be lower. But from your unit holders' perspective, I think if you are looking for a high yield vis-a-vis treasury bonds, fixed deposit, this is a good alternative. But of course, I would like to also caveat this. Whatever it is, overseas REITs, there is of course a risk. So for example, you have to look at the currency risk, how they manage their capital. These are things that you need to look out for. So maybe I will just talk a little bit about Sasseur. Basically is that domestic consumption aiming at the 3 to 400 million middle class in China. The population in US is about 350. So could you imagine if you have a stake in Sasseur, that means you also have a stake in the middle class in China. So, but of course, you have to look at other factors as well. So that's all. Thanks.
Okay, fantastic. So just to summarize what I heard, freehold land in Europe for industrial properties versus leasehold in Singapore. And summary for you is access to the 350 million retail consumers in China, and of course high yield for both. Maybe just a point on the high yield. The high yield is often a function of the risk premium. And the risk premium is a function of how much comfort investors have in investing in that product. And if you know something better, and you understand it a bit better, that risk premium goes down because you understand it. So most people do not understand their REITs probably as well as they understand the REITs with Singapore properties, which is why that gap is there between the 5 to 6% yield of a REIT with Singapore properties and an overseas REIT. But those of you who are here, you begin to understand and familiarize yourself, and you feel a little bit more comfortable. You can accept that actually the risk isn't real. Premium doesn't have to be so much. It can be a little bit lower. So I think that's basically, if I can summarize, that's what we are
Thank you for selling for us.
I think it's a conceptual point that this is the reason why REITs with overseas properties have such high yield. It's not that they are not good REITs, it's just that people are unfamiliar and therefore they give a much higher risk premium. Yeah. Okay, I move on to my next question. Which relates more directly to the property markets in each of the geographies that you operate in. And this question is in two parts. So again, maybe if I can start with Elena. I think you've partly answered it, which was what differentiates the European property market from that in Singapore. I don't know, in addition to the freehold land, if there's anything else, maybe you can add. And the second part, which is the relevant part, is, and what does that mean for investors? And then after Elena, then Yuen can take on. Yeah.
Thank you. I shared some statistics in the presentation I showed earlier on Europe, but I just want to highlight a couple of points, which for me also, having been exposed to the European property sector over the last 9 years, have been quite consistently important. Firstly, European property market is very different from what you have in Asia or in maybe other parts of the world, on the basis that it is actually not as highly securitized as, for example, US. More than 20% of the real estate stock in the US is in listed products. In Asia, I believe that was something like 15 to 17%, plus minus. The statistics is around there. In Europe, only 6 to 7% of assets are in securitized vehicle. Why is that? Because European market is quite liquid without the listed vehicles as well. This means that we, as Stoneweg Europe Stapled Trust, actually have access to a very, very deep pool of investment opportunities. And with our presence in every country in which we operate, we have presence on the ground in each of the 9 markets, very strong transaction teams. We call them the truffle hunters. We actually see assets that are often off market. So there's no 1,001 people bidding for the same asset and the real estate agents going around with a colorful brochure. And by the time the bids are in, you're not actually getting a very good value. Our entire existence over the last 9 years, we have probably acquired 60 to 70 assets, out of which only 1 have been from a tender. Everything else have been off market. We are therefore able to buy very good value assets for security holders and actually use the opportunity to value add, and that gives a lot of upside. So I would say this is actually a key differentiating factor outside of the freehold properties. Very liquid market, presence on the ground. I can't stress enough, we are not just me and my boss and 10 of us here in Singapore. We have 100 people in Europe that are actually working the assets and making sure that we deliver this growth. So that to me is a differentiating factor. Thanks, Nupur.
Thanks, Elena. Yuen?
Thank you, Nupur. You have 100 people in Europe. So just to add on, we have 200 to 300 people in China, just to run the foremost. Okay, so just to add on to what Elena has said, right, the differentiating factor, right? So between the Singapore market and the overseas market. So first and foremost, I think I would say that I'm very familiar with the Singapore market because prior to joining Sasseur REITs in 2018, I was working with Maple Tree Industrial Trust. So that time I was in charge of the portfolio management and reporting. So then prior to that, it was Ascenders in the balance sheet. So that time, my focus was actually more on the data centers, the industrial building, and the business park in Singapore. So then my view of the Singapore property is that I think I have spoken to just now one of our audience here is that the properties in Singapore is actually getting more and more expensive. The valuation is going up. So now what is the difference with China? China, of course, is now, I give you some statistic again. In China, I think most of you know that the traditional or the old retail format of retail malls are not doing well. The numbers there is actually around 7,500 retail malls across China. And now, because of sentiment weakening, people still want to buy, they still want to shop, but they want to buy value-added goods. And this actually benefit the outlet. Do you know how many outlets in China now? 250 only, vis-a-vis 7,500 retail mall, which means there is a margin for growth. So that is the key difference between if you look at purely in the Singapore market and the Chinese market.
Okay, fantastic. Thank you so much. I'll pause my prepared question and take some audience questions. Yes, please, the gentleman here.
I have a few questions. Okay, I think first of all, I think when you look at the small REIT, we don't just look at the yield, because more important we look at the track record. I mean, your share price is actually trading below a discount to your NAV, and actually they say something about your performance. I mean, seeing IPO, your share price actually, so of course going forward we try to see positive, but then actually your track record it's not convincing. That's one thing, and that explains why your share price is below it's actually trade below NAV, and that's why you got higher yield. Okay, a few questions I have is this. First is Sasseur REIT, because you mentioned that you got two parts of the management fee, and one part is actually fee is paid by the sponsor. So can I know how this be sustainable if, let's say, we break out from the sponsor?
It's not from the sponsor. It is actually a formula where there is a fixed component and a variable component. And these are actually derived from the income at the outlet level. So it's not, say, fixed from the sponsor. Maybe I...
No. The fixed portion, you say come up from the sponsor.
Oh, no. It's not. It's actually derived
from the tenants.
From the outlet performance.
So even it's not performing,
there will be a minimum amount, because at that time during listing, I think SGX together with our sponsor was saying that, oh, you are a China REIT, so this is the first time that you are listing. So in order
the tenant or whatever will still fall out the basic portion.
Is from our income gross revenue. Look at the page again, right? Maybe somebody
income gross,
that one.
Okay, the management fee basically is go to the sponsor. So you say you cut off from the sponsor the management fee.
No. It's from the gross revenue. It's a formula from the gross revenue. So what I mean is that the sponsor will guarantee a fixed component amount. Guarantee meaning that even if it's zero sales, or whether during COVID time, there would be this minimum amount that is guaranteed to our unit holders. But it is still derived from the outlet. You know what I mean?
Not very sure where the money comes from.
Okay, maybe I can flash out the slide, right?
Not sure if they can. Are you okay? I think they are going to try to flash out the slide.
Can I come back to your question again?
Yeah.
Okay.
Okay, never mind. Maybe I talk to you later. But then the words are. I just wonder. It's like because the Chinese word for outlet you use what?
Outerlicer.
That one is not very funny because you use the Chinese word 沙市船 is meaningful, no? But the outlet portion I don't know whether is it a better Chinese version.
The outerlicer actually is a direct translation.
Yeah,
from outlet.
But even for me, I look at the term, I shock. No, what is that?
Okay. Any suggestion from your side?
I thought there's a better 词汇 for outlet in Chinese.
A short form is called outline.
But then it's really...
Okay, your slide is up.
So my slide is here, right? You see, you look at this, right? You look at you can see the slide, right? On the left-hand side is our sales. Then on the right-hand side is our gross revenue. What is the component of gross revenue? Rental plus other income. As I mentioned earlier, we have more than 90% of our tenancy is based on commission that we receive based on sales, which is between 10 to 16%. So this is the business model. On the right-hand side is the REITs income model. What is the REITs income model? It's part of, are you able to point? Okay, so on the fixed income, on the EMA resultant rent, this is the fixed component plus the variable component. This is actually part of the green bar on the left-hand side. So when you say sponsor pay, it's actually not sponsor pay, it's actually from the gross revenue. What I meant is that the fixed component, which has a base income in 2018, every year increased by 3%, this will be guaranteed by the sponsor. Got it?
Okay, I got it.
Yes.
Okay, thanks.
Okay, thank you.
Okay, I think that was important clarification.
Yes, yes.
Yeah, okay. Thank you for your very good questions. Maybe I'll take one question. Oh, there's one more. Okay, let's take one more audience question.
Yeah, I have a couple of questions. The first question is quite interesting. The unique model which you showed just now that the person asked. What made you to develop this kind of model and what uniqueness you bring? And I believe none of the REITs Singapore operates in this kind of models. And how confident you are and make our investors strong hope that it will continue to give a good return as you are performing till now.
Can I answer this question first before you go to your next question? Otherwise, I will forget your first question. Okay. Okay. So maybe I give you an analogy, right? This model, right, will force the team on the ground to run on the treadmill. You go to the gym, many people of us go to the gym, right? The treadmill. If you are running on the treadmill, and if you stop running but the mill continue to run, you will fall off from the treadmill. So this model actually forces the operational team. That means on the outlet sales on the left-hand side, the business model, to ensure they run at the best, at their peak. The minute the demand falls, they will have to think of 1,001 way to make sure the income continue. Because on the right-hand side, we have the EMA resultant model with a fixed component and a variable component. So on top of that, I will just address your question, why this thing came about. Like what Elena has said, Singapore REITs and overseas REITs. This idea was actually mooted by our banker DBS together with MAS and SGX. I think we have some SGX representative here, right? SGX that time was actually saying, oh, your commission, your rental is based more than 90% based on commission, 10 to 16%. What happened if you have zero sales? Then you got no rental. And so this thing came from our authorities. So our authorities, kudos to them, they want to protect our unit holders in Singapore. So this is the history of how this EMA model came about. But actually, I would say that till now, we are doing fine and we are doing well. And we are forever whipping our outlet operational team, whipping our China counterparts, make sure you perform. Have I answered your question?
Yeah, and the second question, it's applicable to both. Yeah, so I do not want to tax you alone. Yeah, the question I have, suppose today I or any of the investors around plan to invest, say, 5,000 Sing dollars for a horizon of say 5 to 6 years until 2030 or 2035, who the investor can think of having a kind of confidence that the return, which is essentially your in terms of the dividend, DPU, and the value of the NAV of the shares, yeah, will continue to keep investors happy, and how do you justify that? You got my, or I should repeat it? No, it's okay. You got it, huh?
First of all, I would like to say that if I have a 100% certainty to be able to answer your question, I will not be sitting in this chair. I will probably be happily retired on a beach somewhere. Fact of the matter is that nobody can see the future. Nobody could have seen what happened in March this year, when our company was on a very nice upwards track and performing well after giving guidance, and then suddenly the war in the Middle East started. So yeah, I mean, obviously, and we are in the building of SGX, and you know, we have all sorts of disclaimers on our results, and the reason is that we as management team can do our best. We can be the best in terms of governance, we can be the best in terms of driving income from our portfolio, but we are also subject to market forces, subject to preferences of investors, subject to, at some points in time, real estate is not necessarily always the investment preference as an asset class. People are more interested in chips and so on and so on. So all sorts of disclaimers. Having said that, I have worked for Stoneweg, which used to be called Cromwell, for some of you who remember, for 9 years, since the IPO. I remember how we started, how difficult it was to list it, because it was at that time the largest overseas, purely overseas REIT in Singapore. And in many ways, our listing paved the way for many other overseas REITs in Singapore. We have been through quite a transformative journey over the last 3 years, as I have shown on my slides. I would say that we are now in a very good shape to deliver growth going forward on a basis that we have de-risked portfolio. Our interest cost is 90% hedged or fixed. We have good visibility of our NPI growth from our core portfolio based on European economy. And we do have committed sponsor that has very attractive data center development pipeline that can provide quite a lot of alpha. And this is not just statements, template statements. We really can show you with facts that this is really the case. And to this gentleman's earlier comment about share price performance and trading below NAV, and my colleague in the audience, our IR manager, Noel, can tell you, every day we go to the office and our CEO, the first thing he does is, what are we doing to improve our share price today? It's really not my favorite question, but it's a fact. And the reason is that we are very aligned with you. We can do what we can in terms of giving you more confidence in our underlying performance. And I would like to see that NAV gap lower. I would like to see us seen as a risk premium similar or better to what you can see in Singapore market and Singapore investors. And hopefully 2020, 2035, if you bump into me in the street and say, good job, you guys, hopefully, yeah.
Yeah, in fact, I had purchased this, the REITs when it was a, that common, what was the name? That
Cromwell.
Cromwell, yeah. And then you embark into a new one, Stoneweg. And still I'm holding, that means it's in the satisfactory level, and I do believe the rest of the investors who have invested in you so far have no so much of grudge or unhappiness that they will not to continue to hold it.
Thank you for your support.
Yeah, and since you are embarking into data center, which is the hot market now, it's expected that you'll give a due consideration to see that our DPU increases with that kind of portfolio embarking. Thank you.
I would like to just say that it is data center development, which is very important because the profits from development stay with the REIT, which is different from stabilized assets. Risk is higher, but returns are also higher.
Yes.
Thank you.
Thank you.
Thank you. Elena has answered the first part of the question, which is that I'm not a fortune teller or a soothsayer where I can predict what is going to happen in future. But I'd like to bring your attention back to what Nupur has actually stated earlier on during this panel discussion. She says that our yield is between 8 to 9. The key element to the higher yield is because of the risk premium. The risk premium embedded with an overseas REITs. For example, I joined this place since 2018. I know the company does very well. And I also know their operational strength is not only excellent, but super excellent. And they are very resilient. But the value is not reflected in the share price. There's actually a disconnection. Likewise, when I hear your Stoneweg, I think it's a wonderful portfolio.
Likewise for Sasseur.
Yes, yes. But there is a gap. Why? Because investors, be it unit holders, be it institutional investor, they embedded a risk premium to this portfolio, which I think we have to work harder. We have to try to have sessions like that to explain more, let our investor understand who we are and what we do. So maybe I just touch a little bit on what is our growth plan, because this is still work in progress, is that we know our share price is down. One of the key reasons, not down, actually after our announcement 2 weeks ago, our share price actually went up to above 70 cents. Then it becomes milder a bit because overall the market also came down. So the thing is, because of the China premium or the risk factor that many of our investors embed in it. So what we do is that we will continue on our China story, which is the middle class, the outlet mall, value for products. But we will have a China plus one. So what is China plus one? You know that in China, we know that the Chinese government, as well as the businessmen, has a look south strategy. What is their look south strategy? They want to expand their goods and product and services to this part of the world, whether it's Southeast Asia and all the way down to Australia. So we are now actually actively looking at projects in this part of the world where we can incubate and bring in the expertise of our strength in China, later on materialize and mature this estate. And once these are done, we will put it into our REITs, into our REITs platform. And with that, we hope that we will be able to up the value. And if you invest in us now, you enjoy a high yield. And if in future, we are able to change the market and we continue to grow, the share price goes up, maybe 5 years, 6 years down the road, well, you enjoy high yield, and then you also enjoy a share price. Maybe the time the yield comes down a little bit because the share price went up, but you enjoy capital gain. So that's all I can say for now. But I think both of these REITs now, what we are doing is that we are actively working very hard. We are putting our efforts in. For example, in Sasseur, our firepower is 800 over million because our gearing is only 25%.
Yeah,
okay?
That's good. And it appears that your China plus one strategy is going to be a big hope for the investors.
We are working towards that.
Thank you.
Okay, I will just ask a question, and then maybe after that, maybe I take one question, and then we'll come to you. I wanted to ask on risk management. You mentioned, I think you alluded earlier, that REITs with overseas assets, there are additional layers of risk compared to REITs with only Singapore properties. The most obvious one, obviously, is currency fluctuations. So you have to manage that. But then there's also, other things. There's the interest rate in Europe or in China is different from what is here in Singapore. Then there's geopolitics. So a lot of risk management, maybe, I think definitely more than what is required from a REIT with only Singapore properties. So my question to each of you, Elena and Yuen, is how do you do the risk management? And because it's a very big question, maybe you can highlight what are the 1 or 2 key risk management areas that you particularly focus on or you think are important for your REIT? Okay, sure, go ahead.
Okay. Sure. Okay, so our risk, maybe I will share with you 3 key so-called risks of investing in overseas REITs. The first and foremost, of course, would be the exchange rate. So, for example, if let's say Sasseur REIT one fine day decided to buy retail mall in Indonesia, would you invest in us? Okay, of course you will not. Why? Because the rupiah has dropped to its record low. So this is one of the risks. So for us, maybe can we go to the slide on the loan part? Okay, on the loan part. So how we manage this risk? I think we have the loan part. Okay, the loan part. So for us is that China, our loan is about 25% of our total. So what we do is that we have natural hedging. What is natural hedging? I explained before. All our loans are in RMB. That's how we do it. Then, of course, the other one is that you have to look at the country itself also. The country, for example, in China, whether you believe the country can do well, will it become the #1 superpower in 1 decade or 2 decades or a few years down the road? What is the potential? So these are the things that it's not for me to say, but it's for you to judge whether you want to be part of this or not. So this is one. Then the other one that you mentioned is geopolitical risk, right? Yes, interest rate I have answered. Exchange rate. And the third one would be political risk. This one, I actually don't have an answer. I think it's beyond me. But then the other one is that if I personally want to invest in any overseas equities or stocks, I will first look at the fundamental. What is the core business? Are they really doing well? Are they very good in what they are doing? For example, I would proudly say our sponsor is very, very good in their operations. So this is their selling point. I will look at that. So like personally, I will also look at, but I personally invest in the AI and the technology stocks in USA. When you look at it, what I look at is you look at their growth rate, double-digit growth rate and all this stuff. So you look at the fundamentals. Are they really doing well? Are they spending too much capex? Then I invest in it. So fluctuation up and down, I think we just leave it because you are not going to hold it for 2 days, right? You are going to hold it for 1 year, 2 years, or 3 years. So this is the thing fundamentally. So that's all I want to say about that.
Thanks. Yeah, well, since you didn't want to answer the geopolitical question, I'll take this. I would like to remind the audience that, again, Singapore is a very highly regulated environment. The REIT sector, one of the reasons why the REIT sector is so, continues to be a core sector for the Singapore market, close to 12%, right, Nupur, around there, market cap? 10. Oh, never mind, we'll get to 12. With everything that's, yeah, even more. So, why is that the case? And I can tell you because last year when I took on my new role as capital markets officer in addition to investor relations, one of the first things I had to do 9 days into my new role was to lead a 300 million euro debt refinancing. And the key selling proposition for that debt fundraising was actually the attractiveness of the Singapore REIT governance sector. So when it comes to geopolitics, We can't, as my colleague said, do much about what the powers to be are doing, but the regulatory framework that we have in place to a great extent diversifies and de-risks. We have, in Stoneweg, we have a very strong compliance. We have a ERM framework, enterprise risk management framework that has about 15 risks, which our board monitors on a quarterly basis. Each of the management team is responsible for a specific risk. And when you look at Europe you may think is, one continent, but you have seen the difference between countries. Our portfolio is very diversified, so if one country is not doing so well, or one real estate sector in country is not doing so well, we actually have the opportunity to deprioritize that country and invest higher in another country, and we can do this in a very, very easy way. And I don't want to take more time, but I've shown you our debt profile chart earlier on, and you've seen that we have de-risked our debt for the next 5 years. We have no debt. So I have other jobs to do, but debt is currently something that I can say, okay, we are happy where we are in terms of hedging and so on. So from that perspective, that's how we manage both interest rate risk and currency risk. Euro is our natural currency, our functional currency. All our debt is in euro. So from that perspective, we are relatively de-risked. Okay. Thank you.
Thank you. I'll take the audience question here. Yeah, the mic is coming.
Hello, hi, Yuen and Elena. Thank you for the insightful presentation today. I learned a lot, despite owning Stoneweg shares, I think, for the last 4 years already. Yeah. Session is now looking very interesting after I understand better how the model works. Yeah. So one question I have is that it seems that the share prices for REITs tends to fall significantly after they go ex-dividend. Yeah. So like for example, Stoneweg recently, you're paying a 6.6 cents dividend, but your share price falls 6 cents right after the X day, right? Goes X. So would the REITs be open to paying a quarterly dividend to lend more supports to the share price, because that will increase the friction for traders, and also it will also generate quarterly interest in terms of the dividend payouts, and are you on track in terms of what you're expecting to pay your payouts? And of course, investors can enjoy a quarterly payout while instead of waiting for 6 monthly. Yeah,
thank you for your question. I can answer this question in a very, very specific way. And it's a question that comes very often and something that our board has on a number of occasions asked. The short answer is we would like to be able to do this, but operationally, given that we are dual currency trading and we also pay dividends both in euro and Singapore dollar, the timeline of paying a quarterly distribution, factoring in all these, is a little bit challenging. There's a number of milestones we need to hit. I'm not going to bore you with paperwork and so on. So operationally, it's a little bit challenging, and it's also expensive, because for us to process a quarterly distribution and half-year distribution, there is a cost attached that you can look at SGX fees. And we do actually want to make sure that that money comes back to you and not necessarily for operations. So these are the two key reasons why we considered, and for now, operationally, it's not something that's a priority. Our priority is, as you have seen with our recent announcement, to improve margins, which we're actually working very hard to achieve. I appreciate your point on ex-div, and I can tell you, after so many years in this industry, once the company goes ex-div, there is always somebody who says, what happened to your share price? Why suddenly the price dropped, right? And reality is that if you look historically, and you're very right, and that's something that we watch very closely. So the first day we went ex-div, we actually closed 4% lower. We started at 6 and then we closed 4%. And yesterday share price dropped, right? So okay. But we have seen, what we have seen is on average, the share price tends to recover within a month to back to pre-distribution level. So and it's an asset class that tends to be, there are days when it's just reacting to interest rates, so you can never isolate and say, oh, it's just because you went like this. Sometimes something happened overnight. Somebody is sitting somewhere, tweeted something at 3 o'clock in the morning that affected the interest rate, or, you know. So yeah, so from that perspective, I totally hear you. Answer is that we continue to monitor. You know, the other thing that we continue to monitor is whether we will have distribution reinvestment plan, something that we can also consider to do in future. But for now, there's no immediate plan to pay quarterly distribution. Yeah, thank you.
I just add on to what Elena has said, right? I think she answered most of the reason there's a cost if we do it quarterly. So on our side, we also monitor the capital flow. So recently, right, because especially institutional capital flow now, most of these private funds or institutional capital, when they fund, last time they will look at a longer term. But now, because of the demands on return, they will look at a shorter term time frame. So many a times, this institutional or capital, big capital flow, they will look, their flows can flow not only in Singapore, they can go to US, they can go to anywhere to this part of the world. So now with a shorter time frame, what they will do is that, oh, now I take my dividend, I dispose this share, I use the money, go and put into AI, put into technology, put into this. So this is something that the turnover, the frequency, the volatility is all over. So this is something that on the REITs level, we can't control. We really can't control. What we can control is our fundamentals. So, but like what Elena has rightfully said, usually after ex-dividend, it will drop a bit. But if your fundamentals are there, it will recover. So plus minus is still there.
Okay, thank you so much. We have 25 seconds left to 12 noon. If there are no other burning questions, there is a burning question there. Okay, quick, and a very brief response then from whatever it is.
Sorry, okay. I'm sorry to go back to the same question that we asked to Mr. Cheng on your REITs model, on the pricing. Because generally all the REITs are quite similar, but yours is a bit different because of that guarantee of fees. Can I assume that the guarantee of fee is actually a reference level? It was set in when you lease it, so subsequently every year there's a 3% increase, and that reference level is something that's guaranteed by the sponsor, right? Right, and your computation actually works around until you get, you know that the reference level and the rest of the things are computed based on that. So currently, what's this reference level? How much percentage of this reference, this fix actually, out of the dividend, how much percentage is actually this reference level?
Okay, so first and foremost, I'll answer your question, the 3% reference level. Back in 2018, there was 2 reference levels. First is the growth rate, the annual growth rate of our sales. Secondly, it was the inflation rate in China at that time, which hovers between 2.5% to 3%. So that was the reference level. So of course, things have changed due to COVID, due to and other reasons. Then the proportion between these two hovers between the fixed component and variable component. The fixed component will hovers between 65 to 70%.
Okay, thank you. Then second question is, that means, so the REIT itself would be subject to a credit exposure on the main sponsor, which, you know, under this case, because in the event of SARS or something, if there's no revenue, that guy would be subject to 65% of the DPU.
Oh yes, but that also bounces back to the strength of our sponsor. So it has already been proven that it's not an issue for them. And then on top of that, the cash flow of our sponsor, having 16 outlets, which most of them are doing very well. So it is not personally, I don't think that is really a concern. And the other one is, of course, our very low gearing. And thirdly, most of you don't know, is that there is a minimum guaranteed bond, which the sponsor has committed to the REITs as well, which is about RMB 100 million.
Okay, thank you.
Okay, Thank you so much, Yuen and Elena, for really, I think, very good presentations and for patiently answering all the questions. Thank you so much, audience, for coming here on a Saturday morning. Hopefully, it was useful. You can, rethink about your investments in each of these two REITs, and happy investing. And let's all hope that all their hard work on the ground, the market conditions are favorable, so that the stock prices also move in the right direction. Thank you all.